So this is the life cycle of an equity stock, the life cycle of a stock, as well as how the money flows from the small investor to the big investor. What happens is stage one, I call it the stage of the smart investor. The smart investor sees a value in a stock which is not extensively covered. It's a small or a medium scale company, mostly having market cap of below 1000 crores. These guys find value in the stock, they buy. At that time there is very less liquidity. That is stage one. Stage two is where there is insider information running around brokerage houses who start covering the stock, and then they start kind of recommending that stock to their select few clients, and don't let the information out till the time all the shopping has been done. This is the stage two. Stage three is where the stock actually breaks out. So from 100 it maybe goes to 150, 170, and that is when the short-term traders or the momentum traders capture the movement of the stock, seeing the liquidity, seeing the growth. They do their own due diligence and they start buying, which propels the stock further up. Now by this time there is the next stage which propels the mutual funds and the institutions to buy the stock, because at that stage the stock, the market capitalization of the stock, the liquidity of the stock is already fulfilling the criteria of these big institutions. So they start buying and they again propel the stock up further. Now at this point in time, the stock gets extensively covered in media, social media, all the Twitter traders, all these guys cover the stock, and then which leads to a FOMO among the retail investors, and these guys step in at the highest prices already when the stock has gone up maybe 10 times, 20 times. And when they start stepping in and the stock starts getting extensively covered, also as a coincidence what happens is the company gives amazing results. They start growing 35-40% CAGR results, and growth in sales, growth in profits, expansion plans, everything is very obvious. Now when everything is obvious, things don't work in the equity markets. So these stocks which the FOMO people or the retail investors are buying, eventually they are buying from these early investors and traders who bought it, and they are easily selling it and creating liquidity for them. This is the last stage. After this, what happens is once a stock takes a dip at the slightest of the negative news in the company, say for example it goes down 20% or 30%. These people who bought at the top, they average out. They try to average and they try to buy more, and eventually they start falling into a trap from which they never come out, and the biggies start and end up selling them till the stock reaches 30% from its highs. After that there is only hope and no story left.
Perfect.